Building secure, stable, sustainable income in retirement with the help of the Vincent Financial Group.
When we customize a full income plan, we hope for the best, but we also prepare for the worst. But every plan and every situation is different.
Get more at retireatlradio.com.
And this weekend, we are here with CFP and investment advisor Aaron Vincent, also CFP Matthew Decker, helping you retire on your terms by addressing three key pillars: tax planning, risk management, and determining your income strategy. My name is Mark Owens. Welcome out to Retire ATL, all powered by the Vincent Financial Group. Aaron Vincent, Matthew Decker, let's start right there. When we talk about the three pillars of customizing a retirement plan, retirement strategies, where is the most important place to start?
That's a big one. I mean, the most important place to start, even though it might not be the most exciting necessarily, the most important place to start is with risk, because everything's built on that. We talk in terms of, we use this analogy of like your financial house. So imagine your finances, your savings, your retirement, your investment. That's like your house. Well, the most important aspect of your house, I don't care, how anyone feels about it, whether it's what you like the most or not, the most important part is the foundation. I mean, you don't get to see it much. It's mostly underground. It's not that sexy. You're not hiring designers to make it look nice. No,
it's the crawl space that was always really creepy when we were kids.
Oh, yeah. That's exactly right. But the fact of it is, like, it doesn't matter how well you do the rest of your house. If that part is not correct and perfect, everything else is going to suffer. And so, we talk in terms of that, the risk and the guarantees and the safety is the foundation we start to build from. So every single time, risk is the place to start.
Right.
Yeah. Not only is it the place to start, but people come into the office and, they'll have questions about, where do we start and how do we do this? And first we have to outline what the risks are. And so a lot of times we'll ask like, well, you've worked so hard for the last 20, 30 years, you're getting ready to retire. What are the things that you're worried about? What are the things that you think are the biggest risks? And we'll pose the question. And we even do this sometimes when we're doing educational workshops around the Atlanta area. We'll ask the audience, hey, what are the biggest risks to your retirement? People say healthcare, inflation, taxes, market volatility. And we're like, yep, totally. Those are all absolutely risks to your retirement. But actually, the number one risk to your retirement, unfortunately, is you. You're the number one risk to your retirement.
Yep.
And then, we provide a little bit more context, but it always comes back to risk. If you're not comfortable with the risk that you're taking in your portfolio, and let's just pause right there. Most people don't even know how much risk they're actually taking in their portfolio. But if you don't know how much risk you're taking in your portfolio, if you're not comfortable with the level of risk that you're taking in your portfolio, well then, Aaron, your favorite quote I think is appropriate here.
Is your portfolio, oh no, my favorite quote. Yeah. That is by everyone's favorite, Mike Tyson. Everyone's got a plan until you get punched in the face.
That's right. And so if your portfolio gets punched in the face and you're taking too much risk, we get emotional, we make quick decisions. And whenever you get emotional, making quick decisions after getting punched in the face, that's where people get hurt. Yeah. And that's why oftentimes you're the number one risk to your retirement. Because if you make emotional decisions, snap decisions, if you don't have a plan that looks forward, if you're just kind of living in the moment, hoping that the market cooperates with your plans, that's where people get hurt.
Absolutely. That's a good point, Matt. And, a lot of the folks that we talk to are married.
Yep.
And what we often find is that when we go through our risk sort of quiz, which is a lot of fun, actually, it doesn't sound fun necessarily. I don't know that taking a risk quiz, finding out your risk score is all that entertaining sounding, but it really is. It's pretty fun.
But it's enlightening.
It is enlightening. Yeah. And it actually is interesting. Like it's
like your credit score. Like it's not fun, but it's interesting to see where do I stand.
And you better know, right? You don't want to just bury your head in the sand. But what we often find is that one of the spouses, and it's never, sometimes it's the husband, sometimes it's the wife. One of them always has a much higher comfortability with risk. And so you've got to have that conversation. If you're going to build a portfolio that's going to, kind of perform for you and work for you for the next 20, 30, 40 years, you better be on the same page. And so, so we talk in terms of having a durable portfolio. What does that mean? Well, Matt said it perfectly a minute ago. You are the greatest risk, meaning it just simply means that when the heat gets turned up, when markets are all over the place or whatever conditions are happening out there, if you're going to be tempted to, or if you're going to fall prey to the fear and the anxiety and the emotions of the moment, and you're going to drastically change your portfolio, well, then it's not worth any of the work that you did to build it in the first place, because it's all out the window now. And so I often say to people, I'm actually not that concerned with getting you high returns. And I say that on purpose in that way, because
what are you talking about?
Yeah. What do you mean? Why would you not?
Why am I paying you then?
I'm here to get low returns. I didn't. That wasn't what I signed up for, and that's not what I mean. But I say it that way on purpose, because then it gets the conversation, kind of perks their ears. Like, what do you mean by that? I'll say, well, here's what I mean. If we can build a portfolio for you that you can stick to through the ups and the downs, so stress tested for whatever market conditions, inflation, taxes, all this stuff. If the portfolio that we build for you, you are able to stick to even through those emotional ups and downs, then you'll be poised when the markets rebound or when the conditions change. And guess what happens at that point? You do get those big, fun, exciting returns because you're already there and having to catch up in time when to get back in and all that. So yes, we're trying to get you as big of a return as we possibly can, but that's not number one. Number one is everything aligned? And that has to start with risk.
But hold on, Aaron. I have a problem with something you said.
Uh-oh.
I got a problem with something you said, because I'm pretty sure I heard you say we work with a lot of couples and it's important to get them on the same page as it relates to risk.
I said that, Matt.
Well, I got a problem with that because, if we're talking about Kate and I, Kate's my wife,
Yep.
If you're trying to get her and I on the same page as it relates to things like risk and finances, I don't see how you're going to win in that situation.
We got to bring your marriage counselor in too at the same time. No, same page. Yeah, it's a good point, Matt. Let me clarify. So that you're both aware of how each other feels about risk.
That's right.
Usually we don't have, like for me and my wife, we don't just say, hey, over a cup of coffee, let's discuss this morning kind of how you feel about risk and how I feel about risk. Like
you don't do that?
No.
Oh.
It's just not one of those topics that we often discuss. But this conversation about your money and your saving and your investment provides a context for that. And so getting you to agree or to have the same risk score is definitely not what I mean. I think that's what you're getting at. That's exactly not what I'm saying. But what I am saying is you've got to both be aware. And if you want to know what your risk score is, maybe you and your wife have had those conversations. I don't know. But you got to call us, 770-741-0120.
Of course, you can get more at retireatl.radio.com. And this weekend, if you've done a great job with your retirement portfolio, you've got a nice savings, you're lucky enough to have a pension, a strong, solid 401k, an IRA, that's where the power begins to really start building upon the gains inside of your retirement plan. 770-741-0120 for that no-cost, no-obligation consultation with the team from the Vincent Financial Group. I want to go back and get even more granular about the risk score and how you determine our risk score. Like for somebody listening this weekend, I've heard it before, I kind of understand it. Walk me through it. Give me the idiot's guides to risk score. What does that look like?
So most financial advisors will have 5 or 6 pre-built models. And the goal of their risk assessment is just to figure out which one of our 5 models is best suited for you. Okay, that's not what we're doing.
Right.
The way that we are actually approaching risk is from a math standpoint. And actually the math involved in the way we approach risk is it's the scientific backing for a Nobel Prize, actually, in economics. So this is real stuff. This isn't like a multiple choice quiz that is only designed to fit you into one of our categories. Right. And so we go as far as if you're a couple, we kick husbands out of the room and we just talk to the wives.
We talk bad about it.
Yeah, that's right, exactly. That's right. We just talk to the wives and we run through this risk assessment, and it takes maybe 15 minutes. And the whole idea is actually to get you to the point where you are uncomfortable with how much risk you're seeing. And once we get to that point where you're uncomfortable, we kind of know where the bounds are. Mm-hmm. And that helps us from a math standpoint, from a numbers standpoint. It helps us determine what type of market loss are you likely to pull the ripcord on and say, I'm done, I'm out, it's too much, my emotions have gotten the better of me. If I see that number on my statement, I'm gone. We need to know what that number is so that we can stay beneath that number. Mm-hmm. So that's what we're doing. And then, of course, we kick the wives out, we bring the husbands back in.
Right.
And we do the exact same thing.
So how is her cooking? No.
And it's fun to do that because oftentimes I think we're on a streak of maybe the last 5 or 6 clients. The wives are actually more comfortable with risk than some of the husbands have been. This is just the last couple of weeks. And on my gut level, like I wouldn't have said that was the case. But it's really interesting kind of what comes out of those conversations.
Right.
And then husband and wife come back into the office and they're like, all right, well, what did you get? Well, what did I get? And then we kind of just sit there and we let the conversation happen. And, the goal is not for one of them to win and one of them to lose. If someone's a 70 score and the other is a 20, the goal is not which one of you has your way. Are we doing the 70 or are we doing the 20? No. The goal is to make sure each of you understands your comfort level and then build that into the plan. So we have a mix of options that have different varying levels of risk. And at the end of the day, it gets blessed by both parties.
Yeah, Matt, that's a good point. You mentioned, kind of the reality of how different these scores often are. And we use real numbers. So as we're having this conversation, we're actually using numbers from these people's portfolios. So if you've got $1 million portfolio that we're talking about, a couple of IRAs, a Roth, and a brokerage account, or whatever it might be, we're actually going to use those numbers in this conversation. So we're going to use numbers like, okay, you're $1 million today, and let's assume with this certain risk score, we can, aim for an 8% annual return. But what that means on the loss side, on the risk side of it, is you could stomach a loss of $100,000, at any given time. Well, using those real numbers and actual dollar amounts totally changes the conversation versus where are you on a scale of 1 to 10 with risk? Oh, you're a 7. Great. That fits this portfolio. End of conversation. Let's move on to asset allocation, as Matt was saying.
I really want you guys to shoot for a 9% rate of return. And if you can't get me a 9% rate of return, then I'm going to go find somebody else. Well, okay, fine. That's one side of the equation. Yeah. But I just want you to know, if we shoot for a 9% rate of return, what it means is when the heat gets turned up, it's likely that your portfolio is going to be at if it's a $2 million portfolio, it's likely that you could have to sit through a $350,000 loss to get that 9% rate of return.
And how long can you sit that out?
And are you willing to do that? And
this
if they
is what
say,
you wanted.
They say, well,
let's talk.
9%, maybe 8. What does 8 look like? And then, we show them what 8 looks like. They go, okay, that's better. What about 7.5? Right. And so you actually end up landing on, this is why you are your biggest enemy. Yeah. You're your number one risk. Most people come in and they say, I'd like to average, whatever the number is. Right. I'd like to average 9. I'd like to average 10. I'd like to average 8. And then when you show them, absolutely, we can do that. Whatever you want to average, we can aim for that. And if we aim for that, here's what it actually means when the heat gets turned up. And how does that make you feel? We got to know how that makes you feel. If you don't know how any of this makes you feel, if you've never had this conversation before, I'm going to invite you to have the conversation with our team. It takes 15 minutes. We can do it over the phone. We'd love to do it in person. But you start the process with a phone call, 770-741-0120. If you're married, we'll have both of you. We'll find out your risk scores, have a conversation about it, and you will have more context with what you're currently doing and maybe what you should do into the future.
And you talked about having that conversation in person. The Vincent Financial Group here in Metro Atlanta, the home office in Woodstock, but availability to meet all across Metro Atlanta.
Yeah, we love to have people in our office because it's just more fun face-to-face. But we realize, look, this is a big city and traffic can be an issue. And I just spoke to someone this past week who was sitting in his house in Johns Creek, and I'm in my office in Woodstock, and we had this very conversation. So we'd like to come into the office in person and see us face-to-face. That's great. Or Zoom works as well. But I want to pick up on something that Matt said a second ago. This is where it gets really fun. It gets fun for me once we have this risk conversation, because the other part of the risk conversation is, what are your options, right? Your investing options. I think a lot of people get kind of confused or just aren't aware of the fact that there are so many investment options out there. It's not, hey, the market in equities is exciting. I prefer that because I like to see big returns. But after this risk score conversation, I'm going to realize I've got to settle for a whole lot less and something way more boring. Yeah. Okay, let's get to no. There are investment options out there that are all over the spectrum. And I think what we often find in our office as we're talking to people is that there are investment options out there that are getting returns that are a lot higher than expected, which with taking a lot less risk than expected. So it's not either I got to go kind of stock market or I got to go CD. Like there are lots in between. And this is where we had that conversation about you may not need to take nearly as much risk as you think to get that 6 or 7 or 8% return that you may be expecting. And that is when it gets really fun because look, if your understanding of financial concepts or of investment options is what you see on your kind of app on your phone or what you see in Google, then you might be seeing 5% of what's out there from an investment option perspective. And so kind of opening up the kimono as as it is, just as far as here's everything that's out there. Some of it you're not going to want. You're going to realize you don't want to see that. But some of it you're like, I didn't know that existed. I want to talk more about that.
770-741-0120. CFP, investment advisor, marriage therapist. They do it all at the Vincent Financial Group. We invite you to reach out. We have a representative standing by right now to talk to you. And if the line is busy or if it throws you to voicemail, leave a message. We'll have one of the great team members reach back to you ASAP to get you on the calendar to meet with the team from the Vincent Financial Group, Aaron Vincent, Matthew Decker, at a time and a place that's convenient to you and your schedule. Matt, as we're talking about, how you can be risky in your portfolio without undoing all the work that's been done, it's important to determine the mix of safe money to risky money. And we hear that phrase a lot. So educate me on this one. Safe, protected money, risky money, what does that mean?
Yeah, I love that question because I was actually thinking that as Aaron was talking. We got to talk about what it actually means to take less risk or more risk. So I had a conversation earlier this week with he's a guy who he's the number one used comic book dealer in the world.
And he's here in Atlanta?
No, he's not here in Atlanta. He's in Missouri. But number one used comic book dealer in the world. So fascinating conversation, number one. But then awesome. number two, he had this exact same question. He's like, hey, he was a low risk score. And he's like, but I don't understand. I got this low risk score. And so I'm feeling like what that means is I'm just going to have all these safe investments. And how am I going to keep up with inflation if I've just got all these safe investments? And it's a similar question to what you're asking me right now. And so the idea, let's say you call in the office, 770-741-0120, you spend the 15 minutes with our team, you get your risk score, and you're a 30. Okay, what that means is, let's say you got $2 million. The 30 means that over your $2 million, when we average out the risk of all the different components of the portfolio makeup, it's averaging out to a 30. Now, that does not mean that every single investment is a low-risk investment. In fact, it means nothing close to that. We're going to have some investments in your portfolio that are a 99 out of 100 from a risk standpoint. But we may only take that much risk with $100,000 of your $2 million or, $500,000 of your $2 million. And we may have some investments that are a 1 out of 100 on the risk scale. And that may be $750,000 of your portfolio. So the idea is we do need some money to be taking risk. If we don't, then we're not going to keep up with inflation.
Right.
Eventually you lose. So the idea is not everything needs to be safe or everything needs to be super aggressive. No, the idea is let's get 3 to 4 to 5, it might be 10 different silos of investments, all with varying degrees of risk scores. And if we do our job well, not only will you have different sleeves of dollars, risky dollars, safe dollars, guaranteed dollars, but if we do our job well, those different silos should actually play against one another. And you may have a situation where you add up all your risk scores and you average them, and maybe the average is a 60, but because they zig and zag at different times, right? We may have one investment that zigs while another zags. Mm-hmm. What that means is it's actually not a 60 because they play off one another. Yeah. One's up and one's down, and we can actually reduce the risk of the portfolio just by changing the flavor of how the investments behave in different market conditions. And we can actually end up taking a decent amount of risk, but because they move in different times and places, because they respond differently in different market conditions, we can actually reduce your risk even further. And so we can achieve pretty healthy rates of return with actually, offsetting silos from a risk standpoint. It's a technical conversation, but what's cool is when you come into the office, when you start that conversation, it's not just us talking about it. We can show you exactly how it works. You get to see it in real time.
What's also cool, Matt, with diversifying like the way you're talking about, is that we can keep costs down that way. So there are lots of different ways to build a portfolio. And I think the one-size-fits-all approach, and the most common one out there, at least that we see from our competitors, is, well, I'm just going to use mutual funds, right? That's what a lot of financial advisors, a lot of firms say. I'm going to use mutual funds because inherently mutual funds are diversified. So if you have a mutual fund, there may be 100 different stocks that the mutual fund manager picks in that mutual fund. Well, if the entire realm of diversification in your portfolio exists in just various mutual funds, well, then that means that you're paying your advisor or your investment manager their advisory fee, plus you're paying the mutual fund manager their fee, plus whatever ancillary fees, admin fees that come in that. I think the industry average is somewhere over 2% of a asset management fee. Versus there are investment products that we layer in that have an expense ratio of zero, literally zero. And a lot of them that we use are decimal points above zero. So if mutual funds is the only way to go about it, you're paying that entire fee on the entire pot of money rather than diversifying with different investment products that have a much lower expense load. Therefore, not only are you diversified better, it's also less costly for you as the investor.
And we can show you how a reduction in fees actually reduces the risk,
yes,
which is very cool. You can see how fees and risk go together. If you've never seen how fees and risk go together, again, I'm going to invite you, call the office, have this conversation. It's 15 minutes, 770-741-0120.
And if you've done a great job with your retirement portfolio, a solid savings account, a 401k, you're lucky to have a pension, an IRA, that's where the power begins. And we invite you to call this weekend for that no-cost, no-obligation consultation, 770-741-0120. We have a team member standing by right now to talk to you. You can always get more at retireatlradio.com. Quick break and back with more. This is Retire ATL, and it's all powered by the Vincent Financial Group.